Hi, I'm Josh Malinchuk, CEO and President of JM Tax Advocates. I'm here to talk about a very important topic these days, which is around property taxes and COVID planning. And so we'll jump right into the presentation, specifically how to qualify hotels for COVID property tax relief. So these days, it's important to look at managing to avoid unexpected property tax increases in these uncertain times where unpredictability is commonplace. So it's important not to forget about property taxes, because property tax is likely the first or second highest tax burden to a capital intensive businesses these days. And so many times I see that companies will not closely scrutinize their property taxes until they see a big increase with their tax bill. And so by then, they are well past the protest periods and really can't do anything about that increase in taxes. So we're going to talk about how that takes place, why it's important to really scrutinize your property taxes. But it's important, again, to make sure that you don't lose sight of this rising burden to your business these days. So here's an example of where a business has been assessed at a level assessment for a few years at $15 million. And so the company is paying an annual property tax bill of about $345,000 a year, same amount in 2019. And then come next year, that tax bill skyrockets. And why did that happen? Well, it's because the tax rate increased by 30%. And so in states where you're paying property taxes in arrears, the levy process where you're seeing rising expenses flowing into the property tax levy can create unpredictability with your property tax payments that otherwise may be avoided through having a smarter strategy with looking at the assessed values for equity, fairness, and accuracy. So, let's step back and look at COVID. So COVID is creating, in many cases, some winners and losers, with some companies particularly impacted through revenue and utilization and occupancy changes, some on the decline, many are on the decline. And so in those situations, we see that some of those factors actually impact the market value for equipment and for building. And so if that does indeed take place, assessors should actually reduce assessments due to COVID or recessionary impact. But many times we see that this does not happen. And so without, again, a process for scrutinizing and holding that property tax assessor accountable to do the right thing and reflect reality, it's likely that a business will not see the kind of relief that they otherwise could see through a protest and appeal process. So the first step to determining how COVID has impacted a business, is really to ask some key questions. So, what has been the impact in my company's sales revenue? Am I seeing additional expenses that otherwise I've not seen over the past few years? Is utilization being impacted, occupancy, vacancy, output, those types of areas? And, am I having to deal with layoffs? That can be a big red flag that COVID has impacted my property, my business. And, what's happening with my supply chain and rising costs? And so for a hotel, these are oftentimes evaluated through a number of factors. But looking at the travel industry, commonly known that These times are much worse than the September 11th crisis. And so that has really trickled into occupancy, revenue, and daily rate worsening for hotels. Really, they've just plummeted. And so the pandemic has really created a devastating impact for the hospitality industry in the United States and for hotelers these days. So after you've determined, well, my property's been impacted, my business has been impacted by COVID, so what do I do now? Well, the second step, and this is the how-to aspect, is to really build a business case for assessment reductions. And so with hotels, the measured impact for COVID typically is analyzed and documented for loss in value through an income approach. And so, your income approach considers benchmarking your daily rate, your revenue per room, your occupancy, and how all that translates into impact on the hotel's net operating income as measured by market comparison with peers. And then ultimately, a cap rate is applied that is based upon ideally recent sales within the subject property market for that hotel. And so once you apply that, well, there you go. You've got your estimate of value, and then you're better equipped to measure and determine whether your assessed market value closely aligns with reality, which is your true estimate of market value. So, coming back to my comment about why you don't want to lose track of property taxes, why you don't want to fall asleep on them. So these are some simple examples where some hotel property owner operators saw some big time relief by just going through the disciplined process of inserting an experienced navigator who knew what they were doing to really evaluate reality and compare the assessments with the analysis, and then to go to bat with a protest to reduce the assessment and kind of collapse that gap there. So, the first example was a 7-digit savings, $1 million benefit for a portfolio. The second was another portfolio situation. And then the third was for a single property, $340,000 refund for an extended stay hotel. So, those are just primary examples of if the hotel had not undertaken this effort to closely scrutinize the property taxes, they would have been overpaying by those sums of money and possibly had some recurring loss through overpaid expenses because of their property tax overages. So, alluded to this earlier, bringing in the experience can make a big difference. Hotel properties are very complicated properties to value. There's a lot of subjectivity with determining and correlating market data. And so bringing in an advisor that understands the hospitality industry as a whole, how different elements of value correlate to the real estate value can make a big difference. And then being able to tell that story in front of an assessing official to present a credible argument for valuation reduction can make all the difference in the world with either attaining relief or just being denied altogether and overpaying property taxes. So the most important thing that I would say as a criteria for launching and executing an effective strategy for relief would be to start early. So recommend starting at least 6 to 9 months ahead of protest periods. We're starting to kind of come up on that bubble, if you will, for kind of that buffer of timing, because most of the protest periods fall around the second quarter of each year. And so it's important to kind of get ahead of that. Start your homework, look at your calendar, year-end financial metrics, and really starting to dig into the analysis to build that story and build those documents to present and know whether you're overassessed, and to have a good story when your local and state boards start to meet, to deal with protest assessment situations. So, leveraging a navigator can pay big dividends. So our suggestion is to really bring in experience, bring in an advocate that has been there, done that, knows the story for hospitality, and can really, bring to bear credible support so that you are as successful as you possibly can be, especially now more than ever, where your hotel is suffering big time because of COVID shutdowns and a lack of travelers these days. So feel free to call on us. We're happy to help. We certainly do have lots and lots of experience with hotel properties. And so feel free to call either me or Jessica Welcher, our client service manager, to help you with your property tax relief plan for COVID.
Find out why leading companies trust JM Tax Advocates to bring their property taxes back to reality. Get your free evaluation today.